The hidden power of FATCA and CRS. How tax transparency is reshaping global finance. Introduction. The financial transparency revolution. What if I told you that two regulatory frameworks you've probably never heard of are fundamentally changing how money moves around the world? The Foreign Account Tax Compliance Act and Common Reporting Standard emerged from high-profile tax scandals but have evolved into something far more powerful: weapons in the global fight against financial fraud and money laundering. These frameworks aren't just bureaucratic paperwork. They represent a seismic shift in financial transparency that affects everyone from multinational corporations to individual investors. By the end of this article, you'll understand not only how these systems work, but also their far-reaching implications for global finance and compliance. The birth of global tax transparency, a tale of two approaches. The American way, FATCA. Following the shocking 2009 UBS scandal, where the Swiss bank admitted to helping US taxpayers hide $20 billion in assets, the US created FATCA in 2010. This unilateral framework specifically targets US taxpayers with a straightforward message: your offshore accounts are no longer invisible. Between 2010 and 2020, FATCA recovered an estimated $14 billion in tax revenue that would have otherwise remained hidden. The global response, CRS. Taking inspiration from FATCA's success, the OECD developed CRS in 2014 as a multilateral solution. Unlike America's go-it-alone approach, CRS created an international framework for automatic information exchange among more than 120 participating jurisdictions, with one notable exception: the United States itself. While both frameworks share similar goals, their implementation reveals critical differences. Scope: FATCA targets only US persons, while CRS covers residents of 120-plus jurisdictions. Thresholds: FATCA exempts smaller accounts, $50,000 for US residents, while CRS captures all. Enforcement: FATCA wields a powerful 30% withholding penalty on non-compliant institutions, while CRS relies on local enforcement. The convergence that changed everything. Here's where things get interesting. These tax compliance mechanisms have converged with anti-money laundering efforts in a powerful way. Since the European Union's fourth AML directive, aggravated tax fraud is now considered a first-class money laundering offense. This creates a significant multiplier effect. Compliance with FATCA or CRS serves as evidence that an entity isn't involved in tax evasion or money laundering. For financial institutions, this means developing integrated compliance approaches that address both requirements simultaneously. The regulatory landscape has fundamentally shifted from treating tax evasion and money laundering as separate issues to recognizing them as interconnected financial crimes. How these systems actually work. The power of FATCA and CRS lies in their systematic information collection and exchange mechanisms. Customer identification. Financial institutions must verify account holders' tax residency through rigorous due diligence. Account monitoring. Institutions track balances, transactions, and circumstance changes. Annual reporting. Information flows either directly to tax authorities or through intermediaries. Cross-verification. Authorities can cross-reference reported information against taxpayers' declarations. This creates unprecedented visibility into undeclared offshore assets and income, mismatches between declared income and actual financial activities, complex ownership structures designed to hide beneficial ownership, suspicious transaction patterns that may indicate fraud. The Achilles heel, the shell bank loophole. Despite their comprehensive design, sophisticated tax evaders have found ways to exploit these systems. The shell bank loophole represents a particularly concerning vulnerability, highlighted by the Robert Brockman case, where the American billionaire concealed approximately $2.7 billion from U.S. tax authorities. The mechanism is disturbingly simple. Create an entity in an offshore jurisdiction. Classify it as a foreign financial institution under FATCA. Register it on the IRS portal. Open a bank account in this entity's name. The critical flaw? The bank isn't required to identify and report the underlying U.S. beneficial owner. This vulnerability stems from a wrong choice of who to regulate, imposing reporting obligations on private entities rather than on the financial institutions that maintain their accounts. Real-world enforcement, when compliance goes wrong. In 2018, the U.S. Department of Justice secured its first-ever FATCA conviction with Adrian Barron, a former bank executive who helped an undercover agent hide supposed proceeds from fraudulent stock schemes in untraceable accounts. Multiple financial institutions have faced significant penalties. In March 2025, UAE authorities imposed sanctions totaling $713,000 on 7 financial institutions. In 2021, an Indian bank was fined approximately $270,000 for incomplete reporting. In 2017, a Spanish bank faced $8.5 million in compliance costs from the IRS. These cases demonstrate the serious financial and reputational consequences of non-compliance. The compliance challenge. What financial institutions face? Financial institutions must navigate numerous challenges to achieve full compliance. Resource and technical constraints. Diverse legal frameworks across jurisdictions with varying requirements, limited budgets, and understaffed compliance teams, data management complexities with incomplete customer information, technical implementation challenges requiring sophisticated systems, balancing requirements, reconciling overlapping but distinct regulatory demands, explaining complex requirements to customers, keeping pace with evolving regulations. Best practices. How leading institutions are responding. Forward-thinking financial institutions are adopting several key strategies. Establishing dedicated compliance teams focused specifically on these regulations. Standardizing processes across branches to ensure consistency. Implementing regular training programs to keep staff updated. Investing in technological solutions that identify potential compliance issues. Conducting regular internal audits to catch problems before regulators do. The future of financial transparency. As these frameworks continue to evolve, we can expect enhanced scrutiny of entities claiming financial institution status, greater coordination between tax authorities and financial intelligence units, technological innovations streamlining compliance, regulatory reforms addressing existing vulnerabilities. Your action plan, staying ahead of compliance requirements. Whether you're a financial professional or simply concerned about your own cross-border financial activities, here's what you should do now. Ensure all self-certifications and tax documentation are complete and accurate. Request clarity from your financial institution on how they manage FATCA and CRS reporting. Stay informed about regulatory changes that might affect reporting requirements. Consider how your financial structures might be impacted by these transparency measures. The era of financial opacity is ending. Those who adapt to this new reality of transparency will not only avoid potential penalties, but will help build a more accountable global financial system. That was it for this episode. Hope you liked the content. Hit subscribe, tap that notification bell, and leave a comment below telling us which financial crime case you want us to break down next. Because remember, in the world of finance, what you don't know can hurt you. Stay safe, stay informed, and we'll see you in the next video.